Hey everyone, and welcome to the Bricks, Bucks, and Bytes podcast, your weekly dive into funding, market, and investor news in architecture, engineering, construction, and supply chain. Before we get started, a quick announcement. If you're a founder, construction tech enthusiast, or responsible for innovation in your company looking for exclusive insights and content not found anywhere else, you won't want to miss our newsletter. Head over to www.bricks-bytes.com and sign up today to get cutting-edge material delivered straight to your inbox. In this episode of Bricks, Bucks and Bytes, we dive into Tendered, a platform to improve utilization of heavy machinery and a $30 million funding round, RXO's acquisition of Coyote Logistics for over $1 billion, and what this perhaps means for the global economy, and whether product differentiation and complexity drive better gross margins. And now for the episode. Good morning, guys. How are we doing?
Good morning.
Doing great.
Excellent.
Morning.
So, another episode of Bricks, Bucks, and Bytes. I'm glad I finally managed to train myself to get the name right after a little bit of confusion last week. So today we're going to dive into three topics. We've got funding news. We're going to be talking about Tendered, who have earlier this month, maybe slightly before that, but the news broke earlier this month of a $30 million Series A round. Then we'll be talking about RXO, who have acquired a company from UPS Logistics. And then we have a little bit of an investor's take. And the quote, just to tease everyone, is gross margin reflects product differentiation and deployment complexity. But we'll dive into that later. So, who wants to kick us off?
Always Martin.
Always Martin, right? So let's go to Tendered. So what they do? They're revolutionizing heavy equipment operations with AI and IoT. So they are a global leader in digital transformation of heavy equipment management. Recently secured $30 million Series A funding round. This investment was spearheaded by few investors, major firm, parent company of the blah blah blah. The funding round saw participation from new investors such as Quadri Ventures, industry leaders like. I struggle to pronounce this, but that's not the main point. So what they do, they integrate AI and Internet of Things technologies to provide comprehensive real-time insights into heavy equipment and vehicle operations. Is this construction 100% construction related, or not? Or construction is just one of their markets?
I've got a suggestion. How about we watch the video? I watched it just before we went live. It's like 1 minute long, and it gives a little good explanation.
Perfect.
Of what they do. I hope everyone can hear and see.
Can't hear it, but
no, I can't hear it.
You don't actually need sound, so
okay.
Unless I'm audio only.
Empowering sustainable operations. Yeah, so for those who are audio only, I recommend to look at audio and video.
Yeah, we'll post the link in the show notes for sure. So yeah, Martin, to answer your question, not just construction. I saw logistics and a few other things as well there.
Well, logistics is part of the construction, right? So yeah, that's a big part of it. But there's lots of things shipping there as well. What else do they do?
Yeah. I think there's certainly the ability to go into more and more heavy machinery, but the core or the roots of Tendered hail from construction, and then there's quarrying, which is delivering into construction, where you would use a lot of heavy machinery, yellow machines. Mining, I believe, tendered not so much. That's also a different class of machinery. Might be wrong about that one, but historically we hadn't seen tendered being in that space. And then potentially heavy duty trucks, which are possible to expand to. And then if you follow the OEM logic, the manufacturer logic, a lot of manufacturers that would sell machinery into these sectors would also sell machinery into agriculture. Different customer types, slightly different distribution depending on which geography you're in. So perhaps agriculture is something that Tendered right now is not yet considering. But that's the scope of the business. And what's interesting is that Tendered, when they came out of YC in 2018, 2019, it was very, very close to what at the time Equipment Share in the US was doing for a Middle East thesis, which was mostly, hey, let's be a rental marketplace for machinery. And while the company had achieved some scale there, I think they had also figured out and used the scale that they had to figure out what other things perhaps work even better or equally good. And now the company with all of that has, I'm not sure they would use the word pivot. I would call it a pivot. Has pivoted more into actually bringing the machinery, bringing the insights, the analytics for monitoring productivity, monitoring safety, monitoring emissions, monitoring fuel efficiency for these machinery or fleets of machinery for their clients. I haven't seen that lately in Tendered's proposition, but a natural extension, if they aren't already doing that, would then to also go, for example, into spare parts procurement to help the fleets that you help with the maintenance insights, for example, also then gain access to the maintenance services as well as the spare parts. So that would be for me a natural extension that we have seen. And Tendered is very successful. It's probably the category leader in the Middle East. It used to start in the Emirates. But of course, Saudi Arabia is the big construction market that right now a lot of companies want to be in, and that's where Tendered seems to be the preferred supplier, not just for NEOM, from what I know, but perhaps also for other projects in the booming Saudi construction market. So, in terms of category leadership in that local geography, Tendered, I think, is in a good position.
They must have been disappointed when they announced that NEOM is going to shrink a little bit. So, how similar is Tendered to Equipment Share? Patrick. And what I'm actually curious, maybe I will add to this question. So Tendered is in MENA region, Equipment Share, I believe, in the US. So why they are not exactly the same company? Why they don't look exactly the same? And why they are not exactly the same companies if they differ? Is there anything associated with the market or geography? If you can say something about that.
I'm not feeling I know enough about the two market differences. For that, we would have to invite my partner Shup, who covers the MENA region as part of our emerging markets coverage. So rather than make unintelligent statements, let me not make a statement on the difference of the market conditions.
Sure.
Martin, I'd rather not go there. Tendered used to look much closer to what people associate with Equipment Share years ago than what it is today. Today, I think Tendered would resemble much closer, for example, what a Samsara would look like for heavy-duty trucks, but they apply it to the yellow machinery. Samsara is a very successful IoT and analytics on top of the IoT company, based in the US, but also serving other regions. That Tendered is doing something very similar now and very successfully with good scale in the MENA region. Again, the equipment rentals, the procurement of spare parts, the procurement of maintenance services, all are things that you can, if you want, as Tendered, layer on top.
Mm-hmm. Yeah, so the value proposition here is that they're increasing the utilization and efficiency of heavy machinery, which as a result results in, okay, sounds a bit odd, but results in like lower costs for the machinery providers themselves. Is that right? Is that you guys understanding?
That certainly is the promise. Again, it comes from the topic of fleet management, right? So you want to make sure these fleets are heavy capex for whoever holds the machine on their balance sheet. In a lease or rental scenario, it would be the leaser or the company that rents them out. In a purchasing scenario, it would be, for example, the general contractor or the quarry operator. But whoever holds the asset on their balance sheet wants to see maximum utilization. And whoever operates the machinery also wants to see maximum utilization in order to leverage the capex. And that's where oftentimes a lack of visibility hurts you to achieve maximum utilization. Secondly, you can actually really decrease the fuel consumption of these machines by single to low double-digit percentages by running the machinery differently and running them more optimally. And that's a problem that can be solved with analytics. We have seen it in other companies. Historically, what I've seen is when you only offer, for example, the fuel efficiency promise, it's too narrow and too shallow of a proposition to really be adopted by fleets at large. So you need to bundle together these different functionalities of utilization maximization, fuel efficiency reduction, and then safety use cases. And safety use cases within the MENA region, as it's booming and also as it's become wanting to attract more and more international investments. That has happened for a few years, and it certainly wants to happen more because they have actually been, I think, underwhelmed in their expectations of how much international investment Saudi Arabia could attract. The expectation was higher, and so they want to catch up with the expectation. For that, you also need to provide more and more safety into the market to comply with the expectations of international investors. And so when you bundle these different value propositions together is when you can create an interesting solution for the market.
Mm-hmm. So revolutionizing heavy equipment with AI and IoT and $30 million funding, is it not too much for non-tangible operations?
So whether it's too much or not, we would have to go into their numbers now, which I'm not going to do publicly. It's a bit hard to say either or without having the numbers discussion. Mm-hmm. In terms of the market size, many people would think that Saudi Arabia, as booming as it is, and also with the demographic dividends it does have, would allow you to build substantial companies. How substantial, is to be seen for everyone, but substantial is what most people would agree to. So 30 million into a business, if it has the right numbers, would probably still be allowing you to create a company that will return some capital for you.
Mm-hmm. Yeah. How about some of the investors then? So there's some impressive names on here. AP Muller, which is I believe it says actually on the article here, parent AP Muller Holding and parent company of the AP Muller Group, and they are the owners of AP Muller Maersk.
Yeah,
I hope I said that correct. Which is a very large shipping. I only know that because I see their logo on like nearly every other shipping container around the world. They also have Quadri Ventures, Surya Prakash, which is one of the. What is he like an original member of the Stripe team? It says product leader here. They also have Peter Thiel, which is big name, as is Paul Graham from Y Combinator, and then some Wide Ventures, which I believe is the venture arm of Aramco oil company.
Mm-hmm. Yeah. Very big names you're mentioning, Owen.
Huge, yeah. So it seems it's just could and what to add some weight to that. I noticed within some of the press releases that they would potentially be a customer of some of these investors' parent company or investors' main companies. So could it almost, then I started thinking, is this like a strategic investment from these guys in some case?
I would expect so. In the case of Maersk, I couldn't comment. They're a new investor. In case of Aramco, they had already been an investor. And Aramco has been helping Tendered to break into the Saudi market. Aramco is very effective at doing that. We're seeing that in a small number of other companies where that is successful. The Saudi market, does have its own details and nuances that you benefit from knowing quicker by having someone with boots on the ground. And also, like every market in the world, having connectivity, having the access to certain relationships will also allow you to discover things quicker and also scale quicker. So with Aramco having boots on the ground and being an existing investor in the company, that certainly helped Tendered to pull off the pivot and make the geographical focus into Saudi Arabia that they have done these past few months and years.
Mm-hmm. So I wanted to find out your investors' take on investing. So you mentioned earlier that Saudi Arabia is a booming market, and I think everyone kind of sees it. But so if Tendered is concentrated on this market only or in majority, what risk does it bring for a startup from investors' point of view?
Yeah.
Because
So
it can be booming today, but we know from the past it might not be booming in the next 3 months, right? So,
Especially if it starts raining.
That was UAE that you're referring to. Yeah. So being only in Saudi Arabia can allow potentially to build substantial outcomes. The thing that no investor, regardless of what they claim, can predict is what the exit liquidity, the IPO market, the trade sale market will look like within Saudi Arabia for Saudi-only companies. And because no one can predict that, savvy founders will typically tell you, yeah, but Saudi is only my start. After that, I will go to Northern Africa. I will expand into Pakistan. I have the rest of the Arabian Peninsula, and I will cobble together all these markets, and I will dominate the MENAP markets. That's what savvy founders will tell you because there's the uncertainty for the exit liquidity. The truth is, usually you don't start in the largest markets and you become more valuable as you cobble together smaller and smaller and smaller and smaller markets, right? Also because, yes, they're all markets that share certain cultural roots as well as, similar faith, which does generate the proximity in order to do business there with a certain advantage that you have from your home market. But still, they will have nuances. They will have details. No market is the same. So as you branch out into smaller and smaller markets, it usually does not happen unless you already have like insane scale and the distribution motion in a way is repeatable, as well as the product in a way is repeatable. And so that is a double risk that you're creating. The risk of exit liquidity coupled with the risk of can I actually gain more scale and more access to non-Arabian exit liquidity by cobbling together smaller and smaller markets. That being said, that is a risk that can still be worth underwriting, which is why we're actively looking in the region. We've recently made our first investment, which is a UAE-based company that also might potentially branch out into Saudi Arabia. So it's a case-by-case decision where, depending on whether we think the risk is worth taking because the outcome could potentially be large, and it could potentially also be one of the first companies that could access exit liquidity. So that's a case-by-case decision. It can be warranted, but would we, for example, have an Arabia-only strategy? As a global investor, we would probably always bring it into mix, but not dedicate entirely to it.
Mm-hmm. So I got on 2 questions. I don't know if you got something on this.
Nope.
Okay. Have we got something similar in Europe as Tendered in Saudi Arabia?
Yeah, I mean, I would say probably out of memory between 8 to 15 startups that have been doing something similar. None of them really scaled, but also none of them truly dedicated in the end. The way that Tendered did dedicate with their pivot on the operating system, the fleet management, the analytics. Most of them that we had in Europe, again, wanted to resemble a United Rentals or an equipment share, and truly did not dedicate, completely abandoning that part in favor of the software and the fleet management.
Okay, so is it a category clone in that case, in the market where there was no prevalent participant within this vertical?
I would say it started off having some aspects of equipment share to be cloned. But what I would give the company a lot of credit for is actually being smart and savvy of figuring out the attributes in the market that they operate in that perhaps would lead to bigger scale, faster growth, and better margins. And I think Tendered has figured that out. And so right now, I would say they are much less of a category clone. I have less of the attributes of a category clone than they started out with. And I think they have molded it into something that is more unique and more adapted to the local market conditions, which I really like.
Okay. So my last question is, so you mentioned that you recently made first investment in the UAE. I know it's not your region Shub is covering, but maybe you can shed some light on what that was and what else are you looking for in this market?
So we invested in a pre-seed round led by a former Fashionza founder, a terrific company from India that raised a lot of money, but most importantly also had good substance in the business. And one of the founders left the firm and started a company called Marfa in Dubai. And with Marfa, he's building a cross-border marketplace for renovating and new construction of assets in UAE to make those assets fungible and accessible for foreign middle class. For example, Indians, can be other markets that want to invest in the booming Arabian Peninsula new construction and renovation markets.
And what else are you guys looking for there? Is it in a particular vertical or not really?
No particular vertical, no super geographic specific thesis. We will look in generally within the MENAP region at everything that will fall into our scope. And we're still at the stage where we don't want to come too top down and too opinionated of what the region should want. We rather want the region to educate us what in the specific quirks of the region the markets will support.
Beautiful. All right, should we move on?
Yeah, I just wanted to say one thing, which I suppose is kind of significant about Tendered. It said that Tendered raised $5.8 million in seed funding first 12 months after its launch, which apparently at the time was the largest seed round in the MENA region, which was, I suppose, significant.
I mean, that was one of the we spoke to. So good friend of mine was actually an early investor in Tendered. Just a shout out to John at Dynamo. Dynamo is the world's best logistics investor, in my opinion. And John was an early backer of Tendered, and that's why we also had very early conversations with the firm throughout the years. Unfortunately, it was just always the economics of the deal never made sense for us, but the company always had a few makings that my partner Shub really liked.
Very good. Let's go. You touched on logistics, so it's a lovely segue to our next topic. I actually, did anyone want to say anything else more on that, on Tendered, before we move on?
I'm good.
And Saudi? Patrick?
It must be hot there.
Okay, thank you. True value add. Okay, let's talk about this one, which is RXO, which is actually let me take a step back. So we're moving more into maybe logistics and supply chain with this piece of news here. So not just focused specifically within construction. But RXO are a large logistics brokerage, I believe is the word, within the US. And they have just acquired a company called Coyote Logistics from, obviously, the very large company UPS, which I'm sure everyone is familiar with, for more than $1 billion. So I will just kick off to say that whilst this headline says more than $1 billion, I believe that value was less than what UPS bought Coyote for maybe 10 years ago or something like that. I think that the figure was 1.5 or 1.8 billion that UPS originally bought Coyote for, and now have sold on to RXO. So, Martin, do you want to?
Yeah. So what I looked up at RXO, and so this company was set up 2 years ago, and currently I think the valuation is $3 billion. How is that possible? So
there's a lot to unpack here, but it all will lead me to say one thing. So let me say the one thing up front, and then I'll unpack it. The logistics market in the last 2.5 years was very depressed. And many people use the logistics market as a 6 months leading indicator to how the economy is doing. So as long as the logistics market is depressed, 6 months from now, a lot of the observers of the logistics market will think, okay, the general economy will continue to stay not in a booming state. That has changed the last 6 months. It has changed for multiple reasons. We've, I think, teased a lot of times the Suez Canal and the Horn of Africa issues that we had, the Panama Canal drying up, that is an issue. In general, also the economy probably picking up in many parts of the world, and the reorganized supply chains around the supply chains around the globe have begun to become more reorganized and more stable in their reorganization, China plus one strategy, etc. Look up what that means. So all of these confluences of factors have actually led to an increase in freight rates. Not just the last 6 months, but in the last 6 months, it has become quite pronounced, both in ocean freight as well as partially in road freight and trade freight, right? And so that's one thing. And the other thing is in the VC ecosystem for logistics, logistics has received strong funding the last 10 years. It's a sector that in total has received about 150 billion plus of VC funding over the years. But observers in the VC ecosystem, especially at the growth stage, they have lamented the last few years or so, but where are the exits in logistics technology? Here is one. And this is an important one because, and so my message is, we think this is a very good signal, an anecdotal signal. It could be over-amplified signal, but it is a signal that the logistics market, logistics technology market, and the exits for the logistics technology, they could now be happening. So let me unpack. XPO is the mother company of RXO, which is the company that purchased Coyote here. XPO is very, very significant. If you don't know them, you're missing something. Then go research it. XPO is a company created by one of the, in my opinion, top 5 entrepreneurs in the US in operations heavy businesses. Brad Jacobs has founded or created 6 companies that are publicly listed over the last 30 to 40 years, all of them in operations heavy businesses. One of them, by the way, is United Rentals, the original footprint or blueprint for equipment share.
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
United Rentals, billion-dollar company. He also created a waste management company, again, publicly listed. And he created XPO and a few other companies. And XPO, again, the mother company of RXO here, is a logistics provider for heavy-duty logistics, long-haul logistics, logistics in general. And from XPO, now to your question, Martin, how is this possible? He has actually spun out RXO. So RXO was not created from scratch. It was not founded from scratch. It's a company that was a spin out of XPO, which contained XPO's brokerage and services division for XPO. And so that's how RXO never started from scratch. It was spun off, and that's how it also commanded initially all the business, the revenue, the margins, and with that, the valuation. And now RXO, under the leadership of Brad Jacobs, the ultimate leadership of Brad Jacobs, made this acquisition in, I think, $1 billion. UPS lost $800 million on this deal compared to what they acquired the business for. And so RXO, being led by Brad Jacobs and his leadership team, is a company that I will always look very favorably at, and whatever move they make, I will take as a strong signal that they believe they can create value and that they believe the market is ready to support this acquisition to generate strong ROI on this. So to me, this is them buying the bottom and believing that the market for logistics and logistics tech is picking up.
XPO, RXO, I wonder who does marketing for them. Patrick, you mentioned, so what is asset? There are asset-like transportation solutions. So transportation, when I think about it, it's trucks, it's ships, and everything tangible that you can think of. But asset-like transportation solutions, what is that exactly?
So it's the same that you would have in freight forwarders, tech-enabled freight forwarders that received a lot of VC funding, like Forto, Flexport. In our company, in our portfolio, Wizz, which is the Flexport of Asia for ocean freight, as well as for road freight, Sender, or they used to be Convoy, which has gone bust in the last few months, by the way, which was a heavily backed road freight forwarder. And so all of these combined together with RXO, that in the end, you don't own the assets, you're forwarding. So you're helping your customers access the 3PL, the third-party logistics market, for the logistics providers who own the trucks, who have the truck drivers, and who will fulfill. They give you the quotes, they give you the visibility in the market, and they guarantee you that the logistics does happen, but without you having to actually interact with the ultimate carrier.
Beautiful. Yeah. So it's a purely like a SaaS company. Is
It's
it?
closer to a marketplace that is
Yeah.
SaaS enabled, but
Okay.
think of it in the simplest of terms. If you don't tech enable it, it's a brokerage.
Fair. Okay. You mentioned something very interesting. So previously, in the logistics in the last 10 years, we had, or you had, $150 billion funding in the last 10 years. How does it relate
Longer
to...
than that in total. Yes.
Oh, in total. But I still believe it's less than, it's more than we had in construction.
About
Is
5
that
times.
correct?
Oh yeah,
Five
has
times.
to be. Yeah.
5 times less. So that's interesting.
No, 5 times more. So construction is
Yeah,
5
yes.
times less.
Yes. What conclusions can you drive from that?
The same conclusions.
Because
I-
because if I can, sorry, interrupt you.
Yeah.
What's the addressable market for logistics versus construction?
So if in construction you truly were to address materials and labor as well, the construction market size will be a multiple of the logistics market. But the logistics market, again, if also there you would actually attack the actual fulfillment and the services around is also, perhaps $1 trillion market globally. So both of them are substantially large. So the difference in that is not explaining why logistics got earlier funding and more funding. Remember, construction is catching up very quickly. The main reason why logistics was funded with top-down capital allocation earlier, quicker than construction is because it's easier for a generic VC to build up empathy for logistics than it is for construction. So it was just a lower hanging fruit compared to construction, but it was also a higher hanging fruit than the sectors that received capital allocation before logistics. There was travel tech, there was mobility tech, there was urban mobility tech, et cetera, that all got funded before, and fintech that all got funded before logistics. So it's like it's a sequence of sectors that capital allocation goes through, picking the next low-hanging fruit that they have to build empathy for.
Interesting.
Yeah,
By the
perfect.
way, on your comment about the acronyms, XPO also has a business that is called GXO.
You're just proving my point.
So you mentioned when you first kicked off with that piece about logistics being 6 months. Is it 6 months indicator? So just so I understand this with my simple mind is that if logistics is doing well or starts doing well, then 6 months later the wider economy will also start.
That's the correlation that people will look for.
Fine. So
Is
with
it
this,
ISM indicator or is this something different? No, this ISM Institute.
you
of-
sound like you've been working for the marketing company of RXO. Anyway, so with this, you also mentioned, Patrick, that this is potentially a signal. Was it Brad Jacobs? He has sort of like done this recently, $1 billion deal. So are we saying that perhaps in 6 months' time, we could start seeing more of these sort of deals?
I think we're already into the 6 months time frame because the freight rates were picking up already 6 months ago. Now, it's a bit dangerous to rely entirely or only on, let's say, how the freight rates in the logistics market were to be a leading indicator of the general economy, because freight rates can also be picking up because supply is getting shorter and shorter and shorter, which is an effect of longer travel times or longer haulage times because of the Horn of Africa situation, Suez Canal and Panama Canal situation. So in general, if your freight rates go up, it can also be caused by supply shortage. However, we at least think that it was initially caused by supply shortage, and now it's also increased by more demand, which is an economic indicator.
Yeah.
By the way, shout out to my portfolio company, Orba, which my partner Adam led for us in the US. Follow them because they have absolutely terrific daily market insights into the daily global logistics markets. It's a very good company to follow.
Is it OBA or some other?
auba.ai.
AUBA. Okay. Right. So you also mentioned earlier that was it the first exit or one of the first exits in the logistics?
There have always been exits, but in general, the amount of funding that the logistics technology sector has received is not yet in the right contrast or in the right scale to the amount of exits that it has generated. And that's what a lot of like late stage capital allocators, private equity, growth stage and private equity allocators will have lamented over the last few years is, but why should we back more logistics tech? this has been backed for 10 plus years. Where are the exits, and where will they come from? Will they come from IPOs? Will they come from trade sales, etc.? And on the trade sales side, what's interesting is I think a lot of people would have thought that the third-party logistics providers, the big carriers, etc., would be interested in purchasing a lot of the, for example, freight forwarders, the asset-light tech-enabled brokers. And that hasn't quite played out. So right now, the cards will be either that trade sales like this one will now continue to repeat, the one that we have here on the screen, and perhaps that was unlocked now. Let's see. I would say that's a signal, but it's a weak signal that will happen. But it could change the sentiment of the public markets that actually these are, if you look for the right profitabilities and the right margins, very backable businesses. And we at least believe that, because in our portfolio, just take Offload. Offload is like the leading asset-light freight forwarder in Australia for road freight. It's a very profitable business. Wizz Freight, the Forto or Flexport of Asia, in our portfolio has been net profitable, always can go back to net profitable if they choose to. So these margins are there. And I think in terms of an IPO, it always lacks a little bit the consumer and the branding type of play that IPO markets like to generate strong liquidity. But the IPO markets could now gain more and more excitement if we see another one or two strong exits like the one here.
Mm-hmm. All right. Can you compare it somehow to exits in construction?
I would say the multiple that was paid on this business is not particularly great. It's, judging by the public numbers, it's a 0.3x on GMV for a net profitable business. That's not a good multiple. Mm-hmm. And the business had to generate substantial scale in order to generate $1 billion outcome. But I would also say that that's perhaps the floor, right? So if in the future you can perhaps again come back to the 0.5x, or if we're really going into a very strong and liquid market, perhaps the 0.8 or 1x on GMV for a net profitable business, then we can certainly expect, at least from the logistics side that delivers into construction, similar exits, because there are these companies that are tech-enabled and venture-backed around the globe.
Okay. So as we speak about logistics, maybe I can touch on a point. So recently it's been popular to say that we are in the deglobalization kind of period because of some geopolitical events, etc. And we see BRICS countries trading at the largest volumes historically, and there's lots of trades between, for example, Russia, China, India, and perhaps less between China and US. And how this shift in trading impacts companies in logistics, if at all?
What we're observing is more reglobalization than a deglobalization. And
yes.
So the reglobalization is the reorganization of supply chains. India has a very neutral stance to almost everything that is going on around the globe. And it allows India to position itself as the next manufacturing hub for different parts of the globe and different hemispheres, different political systems, etc. And there are other companies or other countries that follow in its footsteps. While the demand side countries, that could be China, that could also be the Western markets, still they will need to rely on, to a good degree, the manufacturing capabilities outside of their country. Now there is reshoring and nearshoring happening, just especially on supply chains and goods and supply chains that are more that are strategically relevant, but it will never reach a degree where we are deglobalized. And you see that. My partner Adam speaks to this regularly. He has built a lot of knowledge in that degree. Is when the US is actually going back to the American hemisphere, right? And overlooking its backyard and using its backyard as manufacturing. So the trade between Mexico and North America has been booming. And so what does all of that do to ocean freight and to road freight and train freight? It's getting reorganized, but it's not getting eliminated.
Brilliant. Yeah, I agree on this globalization and not deglobalization point. 100%.
I mean, you guys are in the UK, right? I mean, the UK has taken very firm nationalistic strategic decisions in the last few years. Does it mean that the UK has become a reshored local domestic manufacturing capacity?
You can't do it here. Yeah, so it's not, and I don't think it will, because then the inflation would spiral completely here. Yeah, we can get into that, but it's going to be very heated and very long conversation.
Yeah. Politics, if we could speak about politics if it's a must, but not openly.
It always opens up so many things.
Yeah, exactly. Yeah.
But if you stick to the economic facts, I mean, have things become cheaper? Have there been more jobs created in the manufacturing sector in the UK?
So I can tell you that my favorite hummus cost 50% more than 3 years ago.
Yeah, prices are going bonkers. Like
Yes.
it's absolutely insane. Even construction costs are like, I honestly have seen from a personal perspective in the last 6 months, I don't know what's driving it, but prices are going like bonkers.
I
I'm
actually
seeing this
enjoy
almost day
because
to day.
I actually enjoy because I increase my fees, so that works well for me. But I can see that what is interesting is, for example, there's lots of Polish builders and Eastern European builders, broadly Romanians as well, who's gone back to their countries. And that is creating even bigger not supply chain shortage, but labor shortage.
Yeah.
And that is causing the cost of the construction works to go up significantly, which I don't know how this will be solved, because looking at the government's direction of migration and who they take people from, last year they got 650,000 migrants. I don't think these economies that these people came from are from like a trades quality economies that people could perform good quality construction works. If we're talking about training these people to do some construction works, we're talking probably about decades or very long years from now. So I don't know how this will be solved. I see increase in prices, and that's the only thing I can predict for sooner or later.
Very interesting.
Yeah, even some of the trade rates, like in like projects I work on, you can look at, say, plastering a wall. Honestly, maybe 6 to 12 months ago, you'd be paying £20 ish. No, between like 15 and £20 per square meter. Now I just got some prices back on a latest job that I'm working on, and the lowest price coming £35 per square meter, and this is in the space of 1 year. Tiling costs, say, like almost doubled in the last year or so.
Well, I'm
Installation
sure
of
if you ask
tiles.
your local politician, he will tell you where. But the benefits of deglobalizing the UK economy and renationalizing it will just come on. They will come. That's what I will tell you.
Yeah.
I agree. It's also
General election in 6 days or something, is it?
is it?
What's the date? Yeah.
And then France.
And then
How are things in Germany, Patrick?
I mean, we're also feeling the cost increase, but I've been spending 4 weeks with my family in the US, and it's not comparable. The amount of cost inflation that you have in the US is from the spending power probably 50% more impactful than it has been in most parts of Europe, including Germany. But everything is getting more expensive as we reorganize.
That's sad, because the US, if we keep US as a benchmark, then we kind of, all people who don't live in the US becoming poorer comparing to the US. So it's a bit sad for us.
I mean, it hits those that can't invest the most.
True.
It hits those that don't have revenue inflating as well. Meaning, if you don't have an income and you don't have the ability to invest,
that's true.
That's a real issue. And it's a threat to societal stability in my mind.
Yeah, that's what I was gonna say. When do we start panicking?
Never. At least not us. Okay, speaking of financials.
Yes. Shall we move on to our investors' hot take? So, Martin, can you set the scene here?
Oh, set the scene. Yes, right. So we went to Next Build conference on Tuesday, Wednesday here in London, and one of the people that spoke was Amar Hanspal, and he had very, very interesting presentations. I really look forward to watching it again if there's a recording from the conference. He said something that really intrigued me, and I couldn't understand what it means, actually, till yesterday when I started researching it. So he said that gross margin reflects product differentiation and deployment complexity. So can we unpack that? What does this mean, and how does impact then gross margin and startup performance, perhaps?
So when you sent me the screenshot, I was not at the event because, event. But when you sent me this, my reaction WhatsApp to you guys was, this is a really smart take, and I instantly loved it. And so the way I have to interpret from afar, because I didn't hear Amar speak about it, but the way I'm interpreting it, maybe with confirmation bias, but I don't think so. I think it's very smart. So the gross margin in the end is reflective of, on the core product or the core service that you sell, are you able to generate willingness to pay because you're solving a real painful problem? And if your gross margin were to be negative, for example, the answer is no, you're not. You actually have to subsidize someone taking something off your hand at a discount to what it costs you to generate or create that good or service, which means that you're destroying value. You're not only destroying value because you add overhead or engineering, R&D to it, you're destroying value, period, right? So a positive gross margin in general reflects that the market is willing to pay you for creating the good or service in the first place. The higher the gross margin is, the more valuable it is to purchase your good. And that's the differentiation and deployment complexity point to Amar. If I have a highly valuable product, which is highly differentiated, very difficult to replace, because differentiated, but also difficult to replace because there's a lot of complexity and uniqueness in it, the more gross margin I can generate because there's a higher willingness to pay than what it costs me to create it, right? That's the gross margin comment, which, by the way, means if you're in a very, very, very slim gross margin business, you could be a wholesaler, you could be a trader on that, which means that the value creation that you have, think iBanking or trading stocks, for example, the value creation is more of a distribution, or perhaps you're trying to catch as close to an arbitrage as there is, but just because you're doing that, you're not generally creating value. Whereas if you have 500%, let's say there have been some bad apples in the pharmaceuticals business where a certain patient group would need a specific type of pharmaceutical, which is IP protected. So I literally cannot recreate it. So the differentiation is very high. The complexity to recreate it is impossible, right? So then if I have 500% gross margins or 1,000% gross margins because I'm selling to my rare medic or drug to a patient group, I mean, that might be unethical or immoral. I'm not debating that, but it is a reflection exactly of what Amar is saying here. And on the other end of the spectrum, you have quick commerce, which is, hey, let me deliver you 50 grams of a spice in 10 minutes because you want to cook with it. And my gross margin on that is negative. How can that ever work, right? So that's the gross margin comment. The operating margin comment, well, everything below the gross margin in the end is to a higher degree fixed cost. Some of that can be variable and some of that can be still scaling with your revenue. For example, marketing costs could have sort of a correlated function with your revenue, but it doesn't have to be. And then there's the overhead and the fixed cost, which typically you want to leverage as much as possible with revenue, right? And so if you can demonstrate a very strong operating margin or contribution margin after sales, after marketing, after logistics, and after your overhead, it means that you generate scale on your fixed or jump fixed cost that only correlate partially with what you're doing as a revenue. And that, by the way, is something that if you don't see strong contribution, if you see, for example, strong gross margin, but you don't see strong contribution margin, that will typically mean that you will have to continuously invest in your product development or the management of your product and the management of your distribution channels more than you would like to.
Lots of things to unpack. But maybe what is gross margin in general, if you can tell us?
I mean, gross margin is revenue minus the cost of goods sold. So the cost that it costs me to generate the product or the service that I'm selling into my revenue.
Right. So my take from all of this is that so low gross margin, simple product or service, high gross margin, more complex product or service that is very difficult to replace or copy by
highly
someone.
Valuable, highly rare will give you the highest gross margin.
Yes, fair. So as an investor in construction, tech, and logistics, do you look at companies that produce like how maybe would you ask them normally what products have you got and give me gross margin on each of those? How important is it for you to have, because maybe there are good businesses who have low gross margins but they can scale it well, or you only looking for the high gross margins? How do you look at
A
this?
low gross margin business, and that is hidden in Amar's statement here, you can only generate a highly profitable company out of it with insane repeatable scale. So it would be in products or services that get bought a ton of times every day with the exact same distribution motion, sales channels, the exact same product. So think, for example, in the construction value chain, that would be dowels or nails, right? So it's a highly standardized product that everybody in the market knows, that everybody in the market needs a billion times a day, and that you can distribute through a highly scalable sales channel and logistics. That's about, but the gross margin on those is, it's not the same as the gross margin of your engineering services, Martin, right? So for that, if you have such a low gross margin, or lower, I should say, I don't think that the nails are necessarily low gross margin, but they're low gross margin. If you have that, you need to find insane repetition on every aspect to make something like that scale. And within construction, things are not as repetitive or as scalable in general as they are, for example, selling perfumes via e-commerce to consumers, right? And so that's something you have to keep in mind for construction. So for us, we generally will not exclude low gross margin. I will absolutely exclude negative gross margin businesses. I will not look at it. So if you're subsidizing your business and you're telling me, yeah, but the gross margin will go up in a few years, I will never believe it. And I have passed on companies because of that. But if you have a lower gross margin business, I would still look at it and evaluate them on the contribution margin. Generally, the higher the margin there is, the more excited we will be, which sounds kind of intuitive to non-VCs currently listening. And it's intuitive to you because it is intuitive, but you would not believe how many VCs are actually not doing it like that.
What is contribution margin? I should have looked.
It depends on your business. Every business, depending on the types of cost items that they have under the gross margin, will have to define it a little bit differently. But in I would say the most generalizable statement, it will be the gross margin minus the sales cost, the marketing cost, the logistics cost, to give you a first level of contribution margin. And then after that, you're deducting, for example, the R&D and the engineering costs that you're investing in your business to get to a second level of contribution margin.
So contribution margin is more accurate than gross margin. Simple. Okay. Are there any examples of construction tech companies, maybe in your portfolio, maybe not, that have great gross margins?
Yeah, absolutely. They are always the businesses in the gross margin. You will always find businesses whose distribution and repetition with existing customers is the best. That's what the gross margin tells you. To the point of the scale here, right? So if I always have to acquire one new customer, I can never do a second sale to the same customer, and acquiring that first customer costs me a lot, then the contribution margin will suffer. You will see it in the contribution margin. Whereas a business that is actually absolutely loved by its customers, that is buying repeatedly, the classic example in VC would be a software that is recurring and people buy it on a multi-year basis, buy the license on a multi-year. That's a classic example, but even in a marketplace, if your customers keep coming back to you to buy the exact same thing, that's how the costs that you invest on distribution, they compound into return. And that's what you will see in the contribution margin.
So being on this conference and speaking to people, and I think you guys written an article on this as well, showing that I think Autodesk has like 90% of gross margin.
Yeah, that sounds about right.
Something like this. So what I always struggle with when thinking about like 90% gross margin on such a big scale is the technology, in my head at least, should be deflationary. So the only reason why it is not deflationary, it is that the market is inefficient. It's not efficient because there's not enough competition, perhaps. So at some point, I would make an assumption that will be efficient enough for those gross margin to go down.
Let me not comment on the competition within the market that you are referencing. So the software market, I think that's a topic in itself. I do think there's competition, but you always have to consider switching costs. And so in the context of design software and the authoring tool stack, the switching costs are extremely high because at least today, because that's pre-AI, let's say, because the practitioners that use that software oftentimes invest like 10 plus years, 10,000 hours into mastering the tool. It's a very high barrier tool with a very high minimum feature set in order to deliver value, which means that it's very costly to regenerate a peer product. And it's very costly to switch away from mastering the tool that you have into a different UI, UX, and different type of functionality. And that's reflected in the high gross margin. Once you have actually locked in your customers, I don't mean this negatively, locked in as in they have gotten used to your product and it costs them a lot to train onto a new type of product, that's reflected in the willingness to pay for the same software.
Yeah, or their product is like 10 times better. Like we had a chat earlier this week with Altaf and Snapshot, and he says that his product is 10 times better than current solutions solving similar problems. So like a Beam solution. So I think it's interesting. I haven't cracked this in my head yet, but thanks for your insights on this.
You're getting there. So guys, how should we close this off? Do we want to, Patrick? Maybe you can tell us what you were talking about on Practical Nerds this week about seasonality.
Yeah, we released a new episode on seasonality within the AECS sector. Different types of seasonalities can hit your business. Usually, after you have gained routine in your market, geographical market, product market, you will after 12, 24 months, you will have figured out that there is seasonality and when it hits. But what's interesting, and for that, I really invite you to tune into our Practical Nerds episode, is the implication for your business, because the implications can be very different, whether you are selling tooling that requires people to make certain infrastructure investments or training investments, or whether you are selling an instant outcome. The impact of the seasonality can be that you want to sell into the high season or you want to avoid the high season. So what you sell makes a difference how you should deal with seasonality.
Yeah, brilliant.
Or you're selling sun cream as well.
Speaking of Saudi Arabia, one. Yeah, I also like a few. I got a few takes from the conference, from the presentation. So one of Amar's comments also was people over-index on competition, and the companies don't die by having lots of competitors, but because they start making mistakes. That's one. That was interesting. Also, founders discount sales by saying good products will sell itself. It's kind of arrogant and rude, kind of.
Strongly agree.
That was very interesting. Do you want to unpack any of those, or should we leave it for next time?
I just want to make one comment. So everything that you're telling me, what Amar has said, I'm absolutely loving it. It's a bit of it's a wordy statement, but I think it's relatively easy to understand. Every category creator, in the end, the fusion reactor behind it is distribution. And that means that if you're figuring out to distribute your product, you will become the category creator. You will be the one that actually dominates the category. Product is what enables you, but distributing is what makes you big.
Mm-hmm. Agree.
Very good.
Signed off.
Okay, guys. Yeah, strongly agree. On that note, shall we end? And I will see you guys next week for the next episode of Bricks, Bucks, and Bytes.
Thank you, guys.
Thanks, Patrick. Thanks a lot. Bye-bye.